Welcome back to the Real Estate Syndicator Live, episode 7. It's a pretty cool. Super excited today. As you guys all know, we've got a very, very special guest. Russell Gray is here with us today, and he, as you guys know, is the co-host of the Real Estate Guys. If you don't know who Russ is, if you've been living under a rock, he is the co-host of the Real Estate Guys. It's actually the longest running broadcast, real estate investing broadcast since 1997. It's been around for about 25 years, way before podcasting even started. So it's one of the most downloaded investment podcasts there is. He's also part of, obviously, the Real Estate Guys put on the syndication seminar we do twice a year. The secrets of successful syndication. And what he's going to talk about today is actually one of the more popular segments of that seminar. So super excited about that. Motto here is education for effective action, which is what we're going to be talking about today. And most of you guys don't know that Russ is my former boss. When I left the firm here in SoCal about, 20 years ago now, or 17 years ago, I went to join Russ as a general counsel. And so he is my former boss. So without further ado, Russell Gray, welcome to the live, and looking super excited about this.
Well, I'm super excited to be here. And actually, I have to confess, I didn't know that I was actually speaking. I thought this was just Q&A and you were going to interview me. We're going to chit chat. But as you might imagine, after all these years, I'm never at a loss for words. Our topic is what? Build your brand, build your network, marketing, that kind of thing.
Yeah. What I was thinking is maybe we could give him the sort of the Cliff Notes version of that presentation. Obviously, that's a very popular presentation at the event, and I know it goes on for quite a while. So maybe the Cliff Notes version of that. I know even before coming on, we had a lot of people that really, what resonated a lot with the live community was just this whole concept of being a farmer versus being a hunter. I think that's one of the main principles that people come out with it. But if you can give us sort of the Cliff Notes version of that, that would be awesome. And then what I really want to do is open it for Q&A, so we can actually answer people's questions and add some value to them and what exactly they're looking for.
Yeah. So I grew up in the streets. I didn't have the patience to go to college. I got married right out of high school, 18 years old, bought a house, started a business, didn't know anything, really learned the power of mentorship. Had my 32-year-old uncle and his 36-year-old friend mentor me in business. And I learned how to sell by being out in the streets of LA selling. And that was a great experience. I learned that business and selling is a lot about relationships. And the relationship component is really one about trust and knowledge of what somebody wants, what somebody needs, how best to communicate with them. And over that period of time, I learned that there were patterns and principles you could memorize. I was shy, I was introverted, socially awkward. I'm the last guy anybody would pick out of a lineup to make a career in sales and marketing, much less become some type of a mini media personality. But, your ambition can override a lot of your fears. And one of the very first things that I learned in life, that sales, which is really the basis of marketing, is a learnable skill. And there are techniques, there are things that you can apply. And if you do what other successful people have done, you can replicate results. Of course, Tony Robbins, way back in the beginning of his career with his original work on limited power, used to talk about that. You find somebody who is doing what you want to do, figure out how they're doing it, think the way they think, act the way they act, and you can produce similar results. The old adage, success leaves clues. One of my very first mentors is now become a very good friend of mine. Tom Hopkins wrote a book called How to Master the Art of Selling, and I recommend it to anybody. And in there, one of the key principles he taught me was to always look at failure as positive feedback, as a way to learn how to perfect your performance, improve your technique. He also took the same principle of saying, hey, as a young guy like me, ambitious, not willing to go to college, just went out and started selling. He found the most successful people had a way they spoke, a way they behaved, a way they acted. And if he could replicate that, he could be successful too. So if you don't fancy yourself a salesperson or a marketer, and yet you have ambition to be in business, you just need to realize that selling and marketing is finding people to talk to. Selling is actually talking to them and getting them to take action, is an essential survival skill. You cannot be an entrepreneur. You cannot own a business if you don't know how to sell. Kiyosaki says every entrepreneur needs to know how to sell. He says that in his book, Before You Quit Your Job. So if you're watching this and you are a W-2 person, you're working in somebody else's system, then before you quit your job, you should read the book Before You Quit Your Job by Robert Kiyosaki and understand really what it takes to be an entrepreneur, because either you know how to generate revenue or you work for someone who does. That's life in the business jungle. Either you know how to generate revenue or you work for someone who does. So the question is, if you're going to be a rainmaker, if you're going to be a revenue generator, how do you do that? Well, the first thing you need to understand is that sales is not really about as much about what you say, or what words you use. A lot of it is about positioning. A lot of it is how you're perceived. So I'll give you an example. You probably remember a very controversial statement made by a very controversial man, Donald Trump. And he made a comment, I think before he got elected president, that he could kill somebody on the streets of New York and get away with it. And the point that he was making is that his brand was so powerful that he didn't have to do everything right and people would still listen to him. I'll give you a different example. We're sitting here on this Zoom call, and somehow a person hacks in, and it's some random person that is maybe, shooting a selfie on a cell phone from the Skid Row, and they look all homeless and they got drool in their motley beard, and you can smell them right through the technology. They just look awful, and they say, hey, everybody should sell stocks and buy gold. And we'd go, look, we're having a meeting here, guy, and Mauricio would kick him out and tell him to go away. Now, if Warren Buffett popped into the room by accident and said, hey, everybody should sell stocks and buy gold, I'm pretty sure I would sit down and shut up. Mauricio would say, Mr. Buffett, please take the microphone and tell us more. And most of us would be multitasking on the cell phone with our stockbroker, getting rid of stocks, getting ready to buy gold. So it's not the words that make the sale, it's the positioning. And so a big part of being a successful salesperson is building a brand that people know, like, and trust. And so the question is, well, how do you do that? And you do that by, there's 5 specific things that you can do to begin to build your brand. And the first one is presentation. How do you show up? Do you look the part? Do you walk the part? Do you talk the part? Do all of the things that are supposed to represent you, are they congruent? Now, in today's day and age, if you're considering doing business with somebody, what's the first thing we all do? We Google them. And if you've got a LinkedIn or a Facebook page, you get your professional LinkedIn page and your suit and tie and you're all buttoned up and you look like a responsible financial person or whatever it is you do, a respectable professional. And then they bounce over to your Facebook page and you're drunk in your underwear, like a spring break partier, a middle-aged spring break partier. That is not congruent. It's going to damage your brand. And so you have to be mindful just of how you show up. If you go to a financial conference, and you could be the smartest guy in the room, but if you're in board shorts, flip-flops, and you haven't shaved in 3 days and your hair is a little messy, that might be fine if you're at the beach, but it's not fine in the context of which you're being seen. So you always have to be mindful of who you are marketing to, what their perception of a credible person in your role is. And you want to look, walk, and talk the part, and it's got to be congruent across all platforms. If you only show up that way sometimes, then people think, okay, you're a fake. Now, you look at a guy like Donald Trump, for example, most of the time when he shows up, suit and tie. You look at a guy like Richard Branson, most of the time when he shows up, he's in a polo shirt, right? They're both billionaires with diverse business interests. So it's not so much that you have to show up in a way that is incongruent with your personality. You just got to be congruent with yourself and manifest some level of success. So presentation is very important. Number 2 is association. You can begin to build your brand by just who you're seen with. When Mauricio first started his practice and he came to work, well, when he first transitioned out of working for a firm and he came to work with us, that was the beginning of him repositioning himself, because the area of law he practiced in the beginning had nothing to do with syndication, had nothing to do with real estate, had nothing to do with investing. It just happened to be an area that he was personally interested in, not the prior. He was in maritime law before. You know, he may have gone to law, and I don't know, Mauricio, you can fill in the blanks, but, you know, you may have gone to law school and said, hey, where's there an opportunity? Or you got trained in general litigation, and the first firm that gave you a job happened to do that, and you ended up there. I don't know.
That's exactly what happened.
That's what happens. And so you're just happy to have a job when you're a starving student with student debt, you know, and that's like a lot of us are. We don't pick something that we love. We just pick something that'll pay the bills, and we're happy to make money. But usually about 5 or 10 years down the road, you wake up and you have this, you know, aha moment. You're like, you know what, this isn't very fulfilling, and the money's not that great. And then you start looking around for your bliss. And so he was looking into the arena of real estate and investing. Had read Rich Dad Poor Dad, heard Robert Kiyosaki. Kiyosaki endorsed us. So Mauricio, why don't you just tell that story a little bit? Because it's a reflection of kind of your transition, but also the effect of our brand and how you and I came to be together and why we're here now.
Yeah, that brand and the Kiyosaki brand, because like many of you, I think, I got to imagine most of you guys here have read Rich Dad Poor Dad from Robert Kiyosaki, but I read that book, you know, about a couple months before I met the guys, and just like everybody else, got blown away, read it on the plane, and it's not so much the content in there, but just the context of that book. As many of us just realized, you know, there was always something in the back of, I think, everybody's mind that something isn't quite right, and that book sort of just, you know, unpacked that. And so I was just reading that book, like, yes, that's exactly what I've been thinking for all these years. And, you know, fortunately for me, I was, you know, driving down the street literally 2 weeks or 3 weeks after I read that book, and I heard Robert Kiyosaki's dropping, because of course, you know, the guys were leveraging his brand. And even though he wasn't as big as he is now, but it was a Robert Kiyosaki, and he said something to the effect of, hey, this is Robert Kiyosaki, author of Rich Dad Poor Dad. If you're serious about investing in real estate, check out the real estate guys. They really know what they're talking about. So his brand is what, you know, if I hadn't read the book, Robert Kiyosaki, that would have meant nothing to me. But because he had that brand, that meant a ton. And I went to go check out the real estate guys. They were doing an event down in Orange County, profitable real estate investing. It was a full day seminar. Immediately could tell that they're completely different, right? It's not the typical sort of run to the back of the room kind of thing. And so that really stuck with me. And then, you know, lo and behold, at some point, you know, Russ, you approached me and said, hey, I've been doing all the legal work here at the guys, and we're looking for an attorney. Do you know anyone? And that's kind of when I said, hey, this is a great opportunity for me to get out of the rat race that I was doing and working at a place, even though it was a great firm, not something I wanted to do. And so that's really was the catapult for me then joining the real estate guys, where it's really where as I always tell the stories, where I cut my teeth in syndication. Because you guys back then, I mean, we were doing a ton of syndications and old school, right? There was no Zoom, there was no social media. We literally, talk about suit and ties, would show up, have a live meeting with 80, 100 people there, and people would come. You guys would make your presentations with white shirts. Remember, you guys were, again, talking about presentation, right? How do you present? Most of the time, you guys are wearing super, you know, stylish suits, always suit and tie, but, you know, monochrome, you know, same colored shirt and the tie. But whenever you guys were asking for money, you guys wore the white shirts, because that was the image that, you know, that you wanted to represent. And we would literally collect, think about this, guys, we would collect offering.ppm docs. We would print them out. They would review them there. I would help them and stuff. And they would sign the documents on the spot and then write us a check on the spot. That's how we used to do it back in 2005, 2006. But yeah, but the branding is everything, because without any of that brand, I wouldn't have ended up with you guys. And obviously since then, I've been able to associate myself with you. And obviously, you know, I owe pretty much everything I've got here going on thanks to you guys, because I've associated with that brand, and people generally know me. It's so powerful. They actually generally know me, not only affiliated with the real estate guys, but they think I'm a real estate attorney because of that affiliation, even though I'm not. I'm an SEC lawyer. But so yeah, it's first of all a fun story for me to tell, but it just does illustrate the points, several points actually, in terms of the brand.
Yeah, and that's the point. So whenever we have a high profile guest on the show, if you listen to our show, you know, we get the drop in. Hi, this is Donald Trump. You're listening to the Real Estate Guys. Hi, this is Steve Forbes. You're listening to the Real Estate Guy. Peter Schiff, Danielle DiMartino Booth. The list goes on and on and on and on and on. We can't even fit them all in one episode. And so we alternate them. But if you listen to our show regularly, we associate ourselves with these names that have credibility in the financial space. Therefore, we have credibility in the financial space. Mauricio didn't know who we were, but he knew who Kiyosaki was. And because Kiyosaki had endorsed us, that's the third level. You know, it was the brand association and the endorsement. So number one is presentation. How do you show up? Number two is, who are you associated with? And it could be a nonprofit organization. It could be a professional trade association. It could be an alma mater, a school. It could be the particular team you have, your lawyer, your CPA. Are you affiliated with A players? Or are you affiliated with the low cost leader? And so these are strategic decisions. Sometimes you pay extra for a particular service provider for their cachet. Their brand is worth more because they have successful clients that you want to be affiliated with. So be very, very mindful of how you associate, and when you're putting your deals together or you're building your brand, think about the association. And then eventually at some point, if you're out there doing a good job, the people who you're associated with will see you, they'll feel good about you, they'll trust you, and then one day they will endorse you. And that endorsement can be worth a ton. Most of you know we have great endorsements from people like Kiyosaki and Peter Schiff and just all kinds of people that we've interacted with over the years. And so those endorsements are pretty powerful. The fourth thing is accomplishments. I mean, at some point you actually have to accomplish something. And hopefully you do that, legitimately, and on your own or in association by adding real value with someone else. But there are ways to gain a degree of credit from things that other people do. For example, if you hire an architect that was the person who designed the Four Seasons Hotel in Beverly Hills, and you say, well, we're using the same architect that did the Four Seasons in Beverly Hills, you have brought the credibility of the Four Seasons Beverly Hills over to whatever it is you're doing. Now, if you said I was one of the investors and my partners and I built the Four Seasons Beverly Hills, well, that's a much better endorsement. If you said I did that all by myself, well, then that's a huge accomplishment, right? So there's ways for you to take, if you're a syndicator, to take whatever amount of net worth you have and allocate it strategically into investing in other people's deals and hiring the right team to build this portfolio of associations and accomplishments that just paint a bigger picture of who you are. And there's nothing dishonest about this. You never want to lie, but you want to be able to tell the truth in such a way that you show up best. Because obviously everybody has to start somewhere. If you're brand new in this business, there's no way for you to say you have a 5 or 10-year track record or a whole bunch of accomplishments. It's no different than when you're going out as a young person trying to get your first job and they say, well, you need to have experience. Well, how can I get experience if you won't give me a job? Well, typically you have to know somebody who gives you a break. And they bring you in, even though you don't know anything, and they give you a chance to do something. And then you get that association. Now you have experience and you're on your way. It's the same thing true in syndication. And so, so there's that. And then the last one in the 5, there's presentation, association, endorsement, accomplishment. And the last one is integrity or consistency. In other words, there can be a lot of really fantastic real estate investment podcasters out there. There could be, just the next Joe Rogan or whatever, I guess Howard Stern's not a good example. I'm trying to think of Rush Limbaugh, famous broadcasters that were just in the top of their class. And that person may be out there right now, but no matter what they do, if they started last week, Robert and I have been at this since 1997. And so we will always have that competitive edge. And you just get that by continuing to show up and practice the other 4 things consistently. And then one day you wake up and you have a well-established brand, not just a well-known brand. And all of those things factor into building trust. So all of that brand building gives you the ability, going back to my early analogy with the homeless person versus Warren Buffett, that when you have things to say, people take you more seriously. It's not that you're more articulate. It's not that you're more brilliant. It's just that you're better positioned. And if you build a strong brand and you deliver a decent message, then the odds are that the people who trust that brand are going to receive that message. And of course, ultimately, your brand has to have a brand promise. What is it that you do for people? And the more personal it is, the more targeted it is. It's one thing to say, oh, I give people a 20% ROI. Okay. That's interesting. It's a factoid. If you say, no, we help people grow their wealth so that they can enjoy time with their family and contribute to causes and enjoy their retirement, right? Now that becomes a lot more personal. And then when you sit down with somebody and convert from marketing into sales, the conversation is, tell me a little bit about your plans for retirement. Tell me about your plans for your children. Tell me about your plans for enjoying your life. Tell me how having successful investments will make a difference. Oh, now let me show you in the context of that conversation, an investment that can fuel your dreams. So I'm not just pitching an investment, hoping they can connect the dots. I'm helping them connect the dots. Some of that is done in the marketing, which is the brand promise. And then when you're having the one-on-one conversation, you make it very, very personal. And I train that in a 2-day workshop that's coming up in May, how to win funds and influence people. And that was a workshop we created just because I had a lot of experience on face-to-face financial selling. And as I was mentoring real estate syndicators, and they were attempting to raise money, where they were really struggling is when they sat down with their investor one-to-one and they couldn't figure out how to present their deal in the context of how it would actually help their investor achieve their dreams. And I said, well, there's a skill for that. There's a process for that. And I can teach it to you, but it's going to take a couple of days. So we started the workshop. I do it once a year. It's coming up. I don't know, Mauricio, have you ever been through that?
Oh, I've gone through that a lot. I was going to say what's great about that workshop. It really is a workshop. It's not a seminar. It's not a presentation. We actually, it's a lot of syndicators at event, obviously, because it's very relevant to syndicators, but there's actually, role playing. We actually go in front of the crowd and we sit down and somebody plays the role as a passive investor. Somebody plays the role of the syndicator, and there's like real-time coaching going on there. So that's something I would highly recommend. And I'll make sure that I put all that information for you when I send out the replay. Russ, a couple of things here that I want to ask is, first of all, I want to make a quick point about consistency, because that's something that's critical the way I see it too, even on social media. And a lot of folks here are on social media, but the main ways that most indicators get their brand out is either through social media or these live events, these seminars. And look, a lot of people start podcasts, but just to be consistent, putting in a podcast, whether it's once a week, twice a week, once a month, day in and day out, a ton of people start podcasts and then, they start fading. And same with, on social. I'm usually on LinkedIn, but I LinkedIn's its own world. And I already know that I've never actually met in person, but I know different personalities on LinkedIn because they're consistent. They're consistently putting great content out there. And I see them. May not see them every day, but because they put content out every single day or 3 or 4 times a week, eventually you're going to catch that person and making a post. So consistency is super huge. I did want to ask you one question. It's actually coming. Michelle, are you on? Because I would love to ask this question that you had, because I think it's relevant to where Russ is going. But you know what? Maybe just for continuity, let me ask it. I know you went through these 5 things, Russ, but Michelle Kimbrough was asking earlier, if you're just starting out, but what's kind of the number one thing? I think that's the way we were talking about. Let me just make sure I got it. What is the number one thing that you can do to build a brand that a syndicate can do right now? Like, what's step one? If you're either just starting or you've been doing it incorrectly. And I want to talk a little bit about that too. I do want to talk about the hunter versus the farmer, but let's just say you haven't done this before. You haven't thought about it that way. You do it a certain way. It's not working, or you're just starting out as a syndicator. What's like the first step? What's the number one thing you would be recommending to start building your brand and building your network?
Get into rooms, virtual or preferably real world, that are full of the right people. Because in that you learn the culture, you learn the language, you're seen, you can get into conversations, which is how you hone your craft. This is a business, syndication is a business of personal relationships. So if you know how to make friends, you can be a syndicator. You just need to make friends with the right people. So for example, if you're going to the $10 a month gym and hanging out with your earphones in and never talking to anybody, the odds of you meeting anybody interesting is very small, because the probability that the right kind of people are in the $10 a month gym are low. And the probability of you having a meaningful conversation with anybody are small if you're just living in your own little world. Right. So if you were to go to the $150 a month gym and you were to be social, still going about your business, not preying on people, then you have a better chance of meeting the right people. We do things. I like to take people firearms training. I got into guns. I got interested in ammunition as a barter commodity, and it was a hop, skip, and a jump into getting interested in shooting guns. Turned out to be a ton of fun, and I organized these groups. So we just came back from last weekend where we had 100 people out for a 4-day defensive handgun training class, and it was great. And you got a chance to, at the end of the 3rd day, we got everybody in a room. We introduced some of the notable people that were in the room. Kenny McElroy was there, and we talked about some of the different relationships that were in the room. Well, we had 1 day left. We'd spent 3 days together. So the whole event was about the main thing we were all there to do. But by 3 days in, we'd all made friends. We all felt comfortable. There was a high level of trust. The end of day 3, we've kind of had this experience together. Let me introduce to you some interesting people that are out on the training range with you. You might not know. This person does gold. This person does residential assisted living. This person does syndications. And I introduced everybody so that on day 4, they had a chance, if they were interested, to engage. If they weren't interested, that was fine. And so I think a lot of people try to make marketing and selling work, and they separate their personal lives and making friends from their work. And this is really much more of a lifestyle. And if you know how to build trust with friends, just go make more of the right kind of friends. And then to take it a step further, if you've read Gary Keller's book, The One Thing, what is the one thing that you can do that will make everything else you need to do either easier or unnecessary? It's really about leverage. If you walk into a room full of people and you can't make friends with everybody in the room, the obvious thing to do, which most people don't seem to be able to figure out, is to figure out who the best connected and most influential people are and focus on getting to know them. If you look at what we've been able to do over the years, Robert and I do events. And when we're in those events, of course, we run the event. We're the most influential people in the room, but we also promote other people's events. And when we show up with a big crowd at somebody else's event, we become very valuable to the event promoter, who's the most influential person in the room. I'll give the New Orleans Investment Conference in Bryan, London as a case in point. When we first showed up there many years ago, we were just 2 guys walking around the floor. He didn't know who we were. We didn't know anything about anything. We didn't know who the VIPs were. We didn't know anything. We just knew this was a pond we wanted to fish in. We wanted to go learn the lingo. We wanted to see who the influencers are. We wanted to meet the demographic and see if these were people we thought we would want to work with. Could we meld the world of real estate with the world of precious metals? After attending the first year, we decided we could. So we went back the second year. And this time we called and said, hey, we'd like to promote your event on our radio show. So we played the card that we had, which was we had a crowd. And we said, we'll promote your event to our crowd. We didn't charge. We just said, we'll do it for free. And of course, what did he say? Yes. Now we're in a relationship by adding value. Sep Bacom, who many of you know, we first met in Orange County way back in, I think, 2010, maybe 11. And he came into the room. We didn't know him. He didn't know us. And he could see that we were trying to do a 2-camera shoot for this presentation we were doing, but we only had 1 tripod. And he said, would you like me to hold the camera? And we said, yes. Well, that began a now more than decade-long relationship with Sep Bacom. And we've become very good friends with him. He's extremely well connected. We've introduced him to all kinds of interesting people. And he was just another person in the crowd who found a way to add value to the most influential people in the room, Robert Helms and myself. And that's opened up all kinds of doors. Sep has ended up on a radio show. He's in our Inner Circle program. We've introduced him to Robert Kiyosaki, Ken McElroy, the list goes on and on, George Gammon, Chris Martinson at Peak Prosperity.
Who else, Sep? I know Sep's on the line here. Who else?
Okay, so
he's somewhere in here.
Yeah, Sep knows the story. So Sep, I mean, what I'm saying is you don't have to have a big podcast. You play whatever value card you have to offer. Sep is always our ad hoc photographer. He takes pictures everywhere of everybody. And of course, then he can offer to send people those pictures and he makes contacts that way. And the list goes on and on. And Sep didn't do it as a tactic. Sep just did it because Sep is a nice guy. He was being himself, but he was able, I think over time, especially as I got involved in coaching him, to realize that, boy, this is a great way to play your cards. So we all have the opportunity to do that. But the point is, once we got in good with Brian, then Brian started asking us to present at his event. And then he introduced us to his VIP celebrities in his industry, and we got to know them. Well, the last time we were at his event, Robert Helms emceed, I think, 2 days of the 4. And I ended up on a panel with Jim Rickards and Danielle DiMartino Booth. Right. I don't know that I've got the intellectual chops to be on that panel. I certainly don't have the industry cachet. Nobody was coming to see Russ Gray sit on that panel. But just, I think, out of respect for what we've done to help support the New Orleans Investment Conference, he put me on that panel. And it was just great. And then Danielle and Jim were promoting it out on their social media. We promoted out ours, but Danielle's got a lot bigger following than we do. And so this is a way my personal brand has grown, just by going out and taking what I have to work with, which is my interest in precious metals and the economy and the fact that I'm the co-host of the show. But again, I'll use SEP as an example. You don't have to have any of those things because you all have something. And I could tell more stories about how I got started before I was the co-host of the show, before I had an economic education, before I had any real credibility in this industry at all. And yet I pretty quickly became one of the more notable people in this industry, even though up until the time I was 40 years old, I was in corporate sales in a completely different industry.
Yeah. Hey, Russ, I'm going to make a quick comment and then sort of pick on that because the fact about adding value, this is kind of one of my big pet peeves, and I think it transitions well into the next thing I wanted to ask. And guys, if you want questions, please put them in the chat. Then Bethany will call upon you. But adding value is really what it's all about. I think one of my biggest pet peeves that I see syndicators or people in general out there is that they're just, when they're putting out content or when they're making the presentation, as you said one of your four things, there's no value exchange there. It's all sort of, I don't want to say selfish, but it's all about them. As you always say, it's never, ever, ever, ever about you, but it's always like, hey, check out my podcast or check out this or check out that, as opposed to focusing on, so how can I add value?
It's a brand promise.
It's a brand promise.
So you put out a piece of content. Hey, check out my podcast. Okay. Nobody cares.
Right.
Discover how you can get this wonderful benefit in your life. That's a brand promise.
Right.
Listen, and this podcast, I explain how, or I interview special guests. It delivers this value to you.
Yeah, and I think, and I think and the issue there is that everybody's kind of working on a transactional model. As I'm a big, one of my marketing mentors is Gary Vaynerchuk, and he always talks about not getting. Everybody wants to get married on the first date. Like you go on this first date, everybody's trying to close the deal on that first date. And when you're working with brand, as you mentioned, it's a much longer game, if you want to call it that, where you're just consistently showing up, consistently presenting yourself, consistently making that brand.
Well, I'll give you a different analogy, which is a little cruder, but I think everybody will get it. So forgive me, but and I'm just going to use it from the male perspective, the heterosexual male perspective. If I show up in a bar and I see a young lady and I'm interested in something for that night, I behave a certain way. If I'm interested in something for a lifetime, I behave a different way. And you have to understand, if you're building relationships for life, if you want an investor who's going to open up their financials to you and allow you to get intimate with them, they have to trust you at a very high level. And if they're going to open up their database and their influence and refer people to you, they're going to have to trust you at a high level. And so if you want that young lady to marry you, you're going to, and all the things that come along with that, which is what many men are interested in, you're going to have to build a high level of trust. And you're going to have to be consistent. You can't be high trust until you get what you want and then, go sleep with 3 other girls, because that breaks the trust. So if you understand the basic premises of building a faithful relationship, that's what this business is. It isn't that complicated. If you think it's about self-gratification, I need you to put your money in my deal so I can get what I need out of life, your approach is 1000% wrong. That's called being a hunter. You're out on the Serengeti and you're hungry and you sleep, and then late at night you go out and you look for the weakest prey and you pounce on it. You choke the life out of it, you flip it over, rip it out, eat the guts, leave the carcass, take a nap, and wake up the next day and do the same thing. There's no second meal. There's no referral. That's a one and done. And a lot of salespeople sadly look at the marketplace that way, and they abuse the marketplace that way. That's why salespeople have such a crappy reputation. And you should be thankful for that, because if you take the alternative approach, you're going to be like a breath of fresh air. And that's the farmer approach. A farmer is hungry too. A farmer needs to eat too. But a farmer has the long view. A farmer comes in and says, okay, I'm going to take this area, this territory, this demographic, and I'm going to begin to clear out the weeds and the rocks and break up the fallow ground. What is that? That is the process of beginning to help people see that you change the way they think. Buy low, sell high. Okay, that's one way to think. What about cash flow? Instead of speculating, what about investing? Instead of paper assets, what about real assets? Instead of things that are with a lot of counterparty risk, what about things that where you actually have a more direct title to the asset that is producing the profit? So you begin to break up the way they think and shift it. That's preparing the soil. And then you plant the seed that, you know, the brand promise, hey, I can help you achieve your financial goals. And then you begin to nurture that person. You plant that. If I'm going to plant an apple tree and I start with a seed, I don't get to eat right away. But if I'm faithful and I show up consistently and I water and I weed and I fertilize and I prune, I don't have to worry about the transaction. The fruit is going to come. It's in the very nature of the tree to give fruit, but it does it when it's ready. My job is just to nurture it until that time comes. So if you nurture investors, if you teach people how to get out of Wall Street and invest in Main Street, you talk about the economics and the financial strategies and the investment thesis behind that, and you're building trust, both in your ethics and your competency, and that's your team, not just you, and continue to stay in that relationship by adding value, at some point, life is going to come along and they're going to have a need and they're going to ask for help, or you're going to offer something in a brand promise related to a specific piece of content or a specific offering. And they're going to go, yes, that's for me. And as you continue to build that trust, as I say, when you build your brand and you build your network, your brand is the trust and the brand promise, and the network is the number of people that are influenced by that brand. If you build your brand, build your network, build your brand, build your network, then at some point when you put an offering in front of that network based on the trust or the power of your brand, it's going to fund. Yep. And so your mission is to go build all that. Now, of course, you got to understand that if you're starving, if your personal finances are in disorder, if you're spending more than you consume, then you're going to be a hunter because you're desperately hungry. You got to reorganize your life, but most of you aren't that way. Most of you don't need to be hunters, but you get desperate. Sometimes people in this business, they go out, and we see this all the time, right, Mauricio? They get into the deal, then they call the lawyer and put the paperwork together, and then they go look for the money. And it's just a mad scramble fire drill that drives everybody crazy, and they reek of desperation. If you will do it the other way around and spend time building relationships and finding out what the capital wants. Are you looking for cash flow? Are you looking for privacy? Are you looking for preservation of capital? Are you looking for long-term equity growth? Are you looking for tax breaks? Do you have retirement money? Would you like to reposition equity? And you begin to educate them on the value or the techniques of doing all that stuff. And then somewhere down the road, you bring them a deal. Well, that's a very different way to approach the market.
Yeah.
And that's the farmer approach.
Right. And there's so many gold nuggets there, but I mean, and that's why we always preach. I mean, you preach it. I really got it from you, which is, the best time to be really raising capital or making these relationships is when you don't have a deal, when you're in between deals, or if you've just started out before you have a deal, because that's the time that you want to be entering into these relationships. You want to be adding value. You want to be trying to figure out what is it that your prospect, your limited partner investor wants, so that when you do have a deal, you can present them. In fact, you always say, hey, a great closing from a conversation is like, hey, great, I now understand what you want. If I were to find something like that, would it be okay for me to send that information to you? Can I email you that? And what are they going to say? Of course,
that's called earning the right. You've earned the right.
You've earned the right.
You've earned the right for the second date.
Yeah, exactly. The second date and the third date.
You earned the right for the second date. And you're just going to keep the relationship alive by continuing to court until it's time to consummate. Yep. I mean, that's the way it works. So if you just, it's a crude analogy, but if you will think that way and nurture a relationship like you would a lover that you want a long-term relationship with, you're going to build a level of trust that most people in our industry just can't figure out. Yeah. They're not willing to go there. And it really just one little paradigm shift, to quote or paraphrase John Kennedy, don't ask what the capital can do for you. Ask what you can do for the capital. Oh, your mission isn't your mission. Your mission is to serve the capital. So your deal is meant to facilitate the goals of the investor, not vice versa. If you can just make that mental shift, it changes the entire demeanor and tenor of the relationship, and the investors will feel it. They will know that you're about them, and they will trust you, because so much of communication is not verbal. You can say all the right words. You can a lot of it, human beings are discerning. And if you're desperate, if you're selfish, if you're using them, if you don't have their best interest in mind, they will sense it. Unless you're like a world-class psychopathic actor, they're going to pick it up, and you're going to be failing and you won't know why. And it's just because you're looking at it from what can the capital do for me? And there's an old scripture that says, out of the abundance of the mouth, out of the abundance of the heart, the mouth speaks. I don't think you have to worry about the words. Get your heart attitude right. If you care about the capital and you take the time to learn what they're trying to accomplish, and you sincerely make their goals your goals, then either your deal can help them or it can't, or your deal might need to be restructured to do it, or they might not be a good fit for the current deal, but now you know they have an interest in another type of deal if you can find a fit, or you might even choose to be unselfish and refer them to somebody else in your network who has a deal that will help them, because it's not about them and they're not yours. It's their money, and your mission is to help them. And ultimately, if you're sowing good seed, karma, if you will, goodwill, what goes around comes around. And you have to have faith in the universe, if you will, to reward you for having that kind of attitude. That's my philosophy. I've lived that way my whole life. I train that way. The types of people I like to be around and do business with feel that way. If I get around people that are hunters, that are scarcity mentality, I just don't do business with them. They're not bad people. They're just not, it's not for me. It's not my tribe.
Yeah, no, that's awesome. And Sap Bacom just went in there, said, what a great quote. And I'm sure a lot of people you're going to see that on my LinkedIn tomorrow. And I'm sure a lot of people are going to be quoting that. So, and then Walter, great point there. It's all about solving their problems, right? Walter's commenting there. I want to be respectful of your time, Russ, but I wanted to see if there's anybody who wanted to chime in and ask a quick question here. I do see Cornelius, and I do see, I think Melanie had a couple of legal questions, so we'll wait till.
I feel like I'm watching Romper Room. Are you anybody old enough to remember Romper Room?
No.
They look through the thing and they go, "Oh, I see Joey and I see Susie."
If you want to just Bethany, I think Cornelius had something. If not, we'll just open it up to questions. But actually, Cornelius, why don't you just unmute yourself and ask your question?
Can you hear me now?
Yep, we got you.
Okay, thank you so much. Hey, thank you so much, gentlemen. Russell, thank you. Russell, great, thank you as well. My question is, with so many things doing personal brands, why you chose the real estate guys and not your own personal brand as your own name?
Well, in my case, I inherited this. I was just out there listening to the radio like anybody else, and heard the Real Estate Guys radio show, and met Robert, and ended up working with him. So I inherited it. But when I took over as the brand manager, I suppose I could have rebranded it. But if you're thinking, well, let's see, if you can remember the old Wendy's, when Dave Thomas, the owner, was the face of the brand, and then eventually he died and they had to replace him with the little redheaded girl, whereas you look at McDonald's, and Ray Kroc was never the face of the brand, and neither were the McDonald's brothers. They created a character, Ronald McDonald. If you create a brand that can transcend a personality, the personality can come and go and the brand remains constant. So, in my particular case, I've never had a plan. When I originally got started in this, I was never intending to be a front man. I was expecting to be the businessman behind Robert Helms. But what ended up happening is that over time, he had a need for a co-host. I was available and stepped up to do it. And we ended up having this chemistry that the marketplace seemed to like. And I ended up in this seat, and I've come to really enjoy it. But that's why I don't have strong feelings either way. I mean, if you want to build a strong personal brand, there are people who do it. There's other people that build big companies and you don't even know who the owners are, and they're very successful. I think you can go either way. I think that the latter, when you build the brand outside the person, it protects the brand in case you have some type of a personal situation that could compromise the business. It's less impactful. For example, if you run a company and you're the face of the brand and you have a son that gets involved in some illicit activity, then that could potentially get on you. Whereas if nobody really knows who you are or who your son is, then the brand is insulated from that family drama. Okay. So there's some advantages, I think, to just having a brand. The other thing is I could relieve myself as an owner of the duty of being the co-host and put somebody else in my seat, and they could also be a real estate guy. You know, it's really hard for somebody to take over the Rush Limbaugh show because it was all about Rush Limbaugh. Can you imagine somebody trying to take over the Joe Rogan show who's not Joe Rogan? But if Joe Rogan had a different show, like the, you know, unfiltered attitude show, then somebody else who could come in with the same type of persona could carry the show on with less disruption. So there's an argument there for that.
Good stuff. Bethany, you want to pull up some questions here?
Well, actually, Cornelius had another one that was pretty interesting, that I think people are talking about, which is creating your own groups for these purposes. Emma has a question. A few people have questions about, you know, what if I don't know these people and I want to create a group? There are obviously some legal implications that I think that was Cornelius was asking, but I think for your purposes, Russ, while we have you, maybe you could talk about if you don't know where to go to find LPs or to find even co-GPs. What about creating your own group? What else? I see SEP is putting some good ideas in here too, but we got you, Russ. So
yeah, that's what we did. When I first met Robert, I had this idea of creating a financial mentoring club, an investor mentoring club, and I pitched it to him and he liked it. So he had a radio show. He advertised a seminar that we did, an all-day seminar. And at the end of the seminar, we offered people at the seminar, if they wanted to have an ongoing relationship, we had a very low-cost monthly membership program they could join, and we would build relationships. That's how we met Mauricio. He came in, went to the front end seminar, decided to join the club. And I think we were charging like $59 a month or something.
Charging nothing. You were charging, yeah, I think
yeah,
maybe,
nothing.
Yeah, zero
nothing.
almost.
But
I mean,
we had
30,
1,000
40 bucks.
members. So,
Yeah.
you know, it was a $60,000 a month business, and it only cost us $5,000 or $8,000 to administer. So it was very profitable. So our marketing literally was paying us. And then I would offer mortgages, and Robert would sell real estate, and we would raise money for syndications. And there were all kinds of peripheral services that were being offered. So whether you do that through content like media, the way we do it now with the real estate guys, whether you do it with meetups, you can do it that way. You can partner with other people. That's what we did in the beginning. We created an alliance of advisors. I took the concept in sales of a leads group where you get together with people who are all targeting a similar avatar, except they're offering them different services. One person has insurance, one person has mortgage, one person has bookkeeping, one person has tax, various things, and you co-op your marketing. And what we did is we co-opt our marketing under the banner of financial education. So we created a faculty of advisors who were teaching out of their expertise, and our culture was no selling. We relied upon the law of attraction. And so that's a great way to do a meetup. Now, we were front of the room guys, and we were perfectly happy presenting, and we liked highlighting our expertise and then marrying that to the expertise of other people. But we had a friend in San Jose, and she was a wallflower. So she would host the event and invite everybody and just invite guest speakers, and she never spoke. But she had the whole list, and she would interact with all the people, and she had relationships, and she raised a lot of money and sold a lot of real estate. So you don't have to feel like you have to be a front of the room speaker, some subject matter expert. All you got to do is have the willingness to organize the party. You don't have to be the life of the party, but you do want to put yourself in a position where you get to be in relationships with people. And then you can take some of the value and invite other people who have groups to cross-pollinate. So for example, we promote the New Orleans Investment Conference to our database, and many of our people go to the New Orleans Investment Conference. When we get there, we promote our annual investor summit to the folks at the New Orleans Investment Conference, and many of them come to our conference. And so there's ways to grow that way by aligning with other people, other events. So you can create a pond or fish in a pond.
Yeah, or align, you know, I'm going to pull Sep's comment here, but, you know, or align with another brand. I mean, the cash flow game, Sep is not, sorry, we're harping on you, buddy, but, you know, Sep is a pretty shy guy, and yet he's been very successful with his meetups, and he does it around cash flow games. He hosts cash flow games, leveraging the brand of Rich Dad Poor Dad. And, you know, he facilitates that, but he doesn't have to, you know, present anything. And that's been a really solid model that not only SEPs use, but a lot of other people. So just associate with the brand.
And look how much free PR he's getting right now just for being a good guy.
That's true. All right. I want a couple more questions here because I do want to respect Russ's time here. I want to let him go at the bottom of the hour. Anybody have another question for Russ.
Melanie, this kind of goes along with what you're saying, Russ. It might be more of a question though for us, Mauricio, but Melanie McDaniel had a question about
Oh, hi, Melanie.
testimonials. Melanie, do you want to unmute yourself and go ahead and ask your
Hi,
question?
Russ. Sorry, I just walking.
Was
so
it
I'm
New
not seeing-
Orleans? I think it was New Orleans that I saw you, right? That's where I met you. Was it New Orleans? Or,
Yes.
Yeah. Okay.
Yep. You're the reason I was there. It works.
Well, see, there you go. So that's proof that I don't just make this stuff up.
Not this time. My question, I was talking to an SEC attorney and he had looked at my website and he said that my testimonials needed to be removed because they're fraud per se. So it was probably more of a legal question for Mauricio and Bethany, but if you have anything to weigh in on that.
I will
happy to
definitely,
listen.
yeah, good to see him. I'll definitely answer that, but I want to have Russ answer before we let him go. And then I'll come back, I'll circle back and we'll answer that question for sure. Anything else about how to raise unlimited funds or couple first steps or anything that you want to ask Russ before we let him go? You can just unmute yourself if you want. Oh, you're so intimidating, Russ.
We've got a lot of folks actually just saying, hey, I want to partner with the real estate guys. What do I do?
There's a lot of stuff going on in the chat. I'm just trying to see.
Yeah,
if there's
I'm reading the chats, trying to find if there's questions, but it's
which-
really just, it's more
Maurice-
testimonials for you, Russ.
Hey, Mauricio, I do have a question. This is Mike Shine. Honored to speak with you, Russ. Anyways, I was wondering if that event in April, what you actually go through during that event.
the sales
you
event.
mentioned. Yes.
It's in May. And what I teach is a process in selling. So I explain the difference in marketing and sales. I talk about the philosophy of hunter versus farmer. I talk about how to build a brand and the importance of doing it. I talk about how to be strategic and leveraged in finding your target market and connecting with influencers to open up databases. And then we just get into the brass tacks of sitting down in an individual conversation. I teach a 3-step process: set the table, touch the heart, and engage the mind. And my basic premise is that most people try to present logically to a closed mind. So you pitch your features or you tell the story and the facts about your deal to a brain that has no reason to be interested. And instead, what I think you do is you get in a position of trust where someone will start telling you about their needs, wants, desires, goals, and objectives. And when you hear what they want, you drill a little bit deeper to find out why they want it, why they really want it. And now you've got emotion involved. The heart is involved. I really want that. And then you help them realize that if they don't take action today and change the course they're on, they're never going to have that. Now they're upset. Now the brain has an order from the heart that says, hey, I want to have that future I was just imagining. Help me get it. It's in that context that you then present the features and benefits of your deal, because the benefits are directly tied to what the heart wants. In other words, now you're talking to an open mind. The reason a lot of salespeople face rejection is because they're talking to a closed mind. They haven't opened to the heart first. And so it sounds very simple, but in 2 days, I break it down into step by step, exactly what you do, what you say. And it's not words, it's attitudes. And then you practice it. And we do it module by module until by the end, you can do the whole thing soup to nuts. And so it's the way I was trained. I was very fortunate to go to a 1-week immersive sales training put on by IBM Corporation that's not available to the public and may no longer exist. I was just very, very fortunate to get it. And that, along with what I learned from Tom Hopkins, who was my original sales mentor, and some other training I got through a guy that had been formerly a trainer with Xerox Corporation. Those 3 major influencers kind of combined with my street experience in both corporate sales and in financial sales over the years, created this curriculum that I teach. And after having worked with many syndicators with no sales experience and having taught it to them and watching them receive, achieve results. And of course, I've done this many times now, so we have tons of testimonials, but that's really what the event is about. And if you're shy, if you're deathly afraid to talk to strangers, then you have to get over yourself and come do this thing. And in some cases, I pull you from the audience and put you in the front of the room in front of everybody, because one of the things you have to do is just get over your fright. You have to get over your fright to engage. You know, it's no different than being in the 8th grade and going to the your junior high dance and so afraid to get out on the dance floor. And then your best friend pushes you out there and you got no choice. And then pretty soon you're like, okay, this isn't so bad. I can do this. It's the same thing.
It's a great event. I'll definitely, anybody else I see a lot of people in the chat saying that we'll see you there. So I'll definitely be there on May 13th, May 14th in Dallas. When I send out the replay, guys, I'll leave a link to all this stuff so you guys can check it out.
Thank you. Thank you.
Anybody else have maybe one last question? If anybody's got one, just unmute yourself. Or sorry, Bethany.
I was going to say, I think a really great wrap up question is coming from Stonebreaker. Stony, do you want to unmute real quick?
Hi there. Yes, Stony again here. I'd like to ask Russ if you could repeat summarize those 5 steps that you told us about earlier.
Oh, sure. Yeah, it's a presentation, association, endorsement, accomplishment, consistency.
It's awesome. Russell Gray, again, buddy, super appreciative of you taking an hour of your time. Really, I know you're super, super busy, so really honored to have had you here today. Thanks so much. Hopefully you'll see a lot of us. You'll definitely see me. Hopefully you see a lot of other folks at the sales thing. And thanks so much for coming on, Russ. And I'm going to stick around. Bethany will stick around. I know there's a couple of legal questions. Melanie, I'll answer yours. But Russ, thanks so much, buddy. Really appreciate you. And I know
I appreciate it. Congratulations. I love what you're doing. You know, I'm on a mission to defund Wall Street, Main Street, investing in Main Street. Anything I can do to help empower an army of people out there who will become part of that mission, I'm happy to help. I'd love to see you all come out to Secrets of Successful Syndication in September. We have just signed a very, very special guest speaker. And we got a room that'll hold 600 people. We had 300 last time. So it's going to rock. Lots of great networking. Love to have you there. You can get all the details from Mauricio. He's been one of our founding faculty members for that event from the very, very beginning. Been doing it for 11 years now.
Yeah, I've been 23 times or 20 times. Well, all right, my friend.
Thank you,
my friend.
Russ. Appreciate it.
Thank you. Take care.
Thanks, Russ. All right. Hopefully that was valuable for you guys. Let me, Bethany, you can go look through it, but I'm going to answer Melanie's question first. So the question was talking to another SEC attorney that your testimonials on your website are per se fraud. I would agree with that. Now, look, let me just rephrase that. I'm not sure it's per se fraud. That might be going a little bit too strongly, but I do believe that if you're doing a 506B, that having testimonials on there, you're responsible for those testimonials, right? So it depends on the type of testimonial that you're having. If the testimonial is simply, hey, I just had an amazing experience with Melanie. She, her and her team were super proactive. They were easy to work with, that kind of stuff. I have less of an issue with those. But if it's a testimonial like, wow, Melanie's team is off the charts. She was able to get double my money in 3 years, or she was able to get me this ROI, or I've invested all this money with Melanie and she's crushed it for me. And you start talking about returns. That's the same as you talking about returns. So just think of it that way. Like, we've always talked, and maybe just a quick summary. We've always talked that when you're doing social media, you can do a couple of things. One is obviously you can value add, which is which I usually focus on, but I won't right now. And the other one is you can always talk about yourself and your company and the things that you do. And so, whether you have a great customer service and this is your philosophy on investing and all that stuff, if somebody does a testimonial on that stuff, which would have been okay for you to talk about, then that's going to be fine. But you're not allowed to put projections. You're not like, I don't like to have any projections, not only on returns, but also on properties. That's another thing I don't like to see on a 506B. It's a 506C, you can do whatever you want. That's why when you say per se fraud, I would disagree with that. I would say putting testimonials is conditioning the market. That's the way I would, at the end of the day, that's how I'd create it. Putting testimonials on your website could be considered conditioning the market. So generally speaking, you stay away from that, unless they are testimonies about some non-conditioning the market. Something I know it's a little bit boring to talk about, what your values, your philosophies, your process, stuff like that is something that you would feel comfortable posting yourself on that website or any social media. Social media is a little bit different because you don't necessarily control that as much. If it's on your website, obviously you control that. If somebody just puts a blast or a post on your social media, maybe there's an argument to have it removed, as soon as you find out, but you control your website. So you're going to be responsible for anything that you put on there.
Sounds good. Thanks.
Thanks, Melanie. Good seeing you.
Thank you. Emma Powell has a great question. Emma, do you want to unmute yourself? There you go.
Sure. I have teenage kids who are interested in what I'm doing and they want to invest in syndications with less than the minimum. They want me to partner up with them. And I don't know how to structure the custodianship because I have custodial brokerage accounts for their stock holdings, but I don't know how to structure it for syndications, how to allow them to get into that before they're 18.
Yeah, that's a great question. We had a question, I think, on the first or second live. The first thing I'm going to comment, it's not directly, it's kind of answering, it's a little bit peripheral, but if you are an accredited investor, by the way, just FYI, if you are an investor is an accredited investor, then their kids will be considered not technically accredited, but they'll be qualified as well. If they're living in your household and they're, I don't even know if they have to be under 18, but so if you're an accredited investor and you want to have your kids involved in that, they would qualify. They would not be considered a non-accredited investor. That's number one.
Even my over 18 kids or just my minor kids?
I believe if they're, as long as they're in, so I would think 25, I think as long as they're living with you at the time. So, I mean, if they're 21 and they're going to, grad school and they're still living with you, if they're under the same household and they're related to you, that's another one. That
Okay.
can't just be a buddy of yours, right? They've got to be related, but that's going to solve that issue. If that, I know that's not directly what you're asking. And then from a custodial standpoint, I mean, this is a little bit more sort of estate, and I am planning on having an estate planning attorney come on, but maybe if everybody's just been scared with everything I've been saying, but there's nothing wrong with you creating that LLC. You could just simply create an LLC that you own whatever 50-60% of, and then your kids own the rest. I would venture to say, actually, if you talk to an estate planning attorney, that's one that they may recommend doing a family limited partnership, although that really doesn't exist. They're just really limited partnerships where the general partner are the parents and the limited partners are the kids. But I don't have any concerns there about doing a sub syndication or funded funds or anything like that. So and of course you can always set up trusts on their behalf, and then you would be the trustee of those trusts. So that's going a little bit maybe overboard, but you can structure it several ways. I would just keep it simple and just do an LLC that that they you obviously have, if they're under 18, you're going to have authority to sign on their behalf. So I would just create an LLC or maybe a limited partnership where you are the manager or the general partner, and then you're also the limited partner, and your kids have whatever percentages. I would definitely talk to an estate planning attorney as well, because there's also tax considerations. There's a lot of gifting rules that you can do, and so gifting them shares tax free. I know there's I forget what the number is, $11,000, $12,000, $13,000 that are tax free that you can pass on every year. So that has to do a lot more with estate planning. And I do plan on bringing on an estate planning attorney as part of the series to kind of guide us on that as well. But I wouldn't be too concerned from the security side of how you put that together.
So it would be a no-no for me to just do it in my name and let them just give me their money. I have to set up something formal.
How old are your kids again?
They're teenagers, so they range in age. 10 is my youngest and my oldest is 24.
I mean, I don't know. I mean, you could have them loan you the money, I guess, and then you could use that and have some contractual arrangement. I think to be honest, I think you're overthinking it a little bit. I don't think there's any issues with, I would just do it. There's all kinds of ways to do it. Yeah. If you just want to take their money and have an oral, you don't have to have a promissory note. It could be an oral note, right? And just like, hey, you're lending me this money, and I'm gonna, so I wouldn't be too. I think you're overthinking it a little bit too much. Okay.
Well, I'm glad to hear it can be simple and not a ton of paperwork.
Think, so. But it is worth a call with, especially it is worth a consult with an estate planning attorney, because there's a lot of other non-securities issues that you want to keep in mind.
Sounds good. Thank you.
Thank you.
When do you ever hear a lawyer tell you you're overthinking? I love it. It never happens.
I'm the anti-lawyer, remember?
Exactly. Ben was kind enough to post, by the way, everyone who's asking, the secrets of syndication, a successful syndication link in the chat if you want that. Otherwise, it'll get reposted. Nick Timberlake has a question, but he's in dad mode right now. And so he's asked if I could please read it for him. His question is, and I think you've addressed this on other shows, can, in a syndication structure, investors use the 1031 exchange to invest as a limited partner or Class A member tax-free, since there are a lot of wealthy investors having this very problem right now?
Yeah, so I've actually done videos on that, and I'm actually planning on doing an updated video on it because there's some additional things that I wanted to address on the tax side. But the the way you framed it, the answer is no, right? So when a 1031 exchange, the key is that it has to be a like kind exchange, so that the limited partner is going to own real estate, right? There's a relinquishing property they're going to give up. They're basically going to sell or trade the property they currently own. And then they must take title the same way they hold the title over here. They need to hold title to the new property. And so they're not going to be allowed to become, members, Class A limited partners, because then it's a direct title to a membership unit. That's not like kind exchange. So can't do it that way. But we do 1031s all the time. I say all the time. We do a lot of 1031 exchanges. And the way I'll give you the Cliff Notes version is, again, they do have to own direct title to that property. So let's hypothetically say that they're going to bring in $1 million and they're going to own 15% of the equivalent of that is about 15% of the project. Then what we would do is we would have them come in and actually own 15% on title of the property. And then the syndication, the Rays would own the LLC, the syndication LLC would own the remaining 85%. So investor 1031 owns 15% of the property. And then the syndication LLC, which raises all the capital, they would own 85% of the property. And then we would, then we would tie it all together with a tenants in common agreement, right? Where we would outline, all the stuff. So that's how you do it from a structural standpoint. The challenge is that it's not a securities challenge. It's an IRS problem. There's a IRS revenue procedure 2002-20, I believe it is, where they have some tax limitations when you do that. So when that situation happens, there's about 15 factors, and I can probably send it out on the replay as well. There's about 15 things that the IRS says, if you're doing this in a syndication, you got to be basically aware of. And I think 4 or 5 of them really directly impact us. One of them is not a big deal, which is similar to the non-accredited thing. You're limited to 35 TIC members, tenants in common. I don't think I've ever seen that. I would definitely not do anything near that. We're talking usually 1 or 2 investors that are doing 1031s. But the big one is that you must distribute the cash flow proportionally, meaning the investor would have to get 15% of the profits of the cash flow on the sale, and then the syndication LLC would get the other 85. You can't do preferred returns. You can't do carried interest. You can't do anything other than direct proportional distribution. Now, you can take a reasonable acquisition fee that gets proportionally paid for, 15% by LP, 85% syndication. You can take a reasonable asset management fee. So if it's 2%, that's fine. But you can't do, hey, they put in $1 million and that equates to 15%, but I'm going to do a 8% pref and an 80-20 or do it something different. So you're essentially limited, and you can't really get paid your usual carried interest, your sweat equity that you usually would take, that 80-20 or that 70-30. You can't get that on that syndication piece. So so that's the challenge, right? And it's a little bit more expensive and cumbersome. So I would not recommend doing that if somebody just wants to come in with 50 or 100 grand. Most of our clients would be a minimum of $1 million plus, and we've done it, I think, for 750, but it's more work, it's more money. And so you definitely want it, but it is mathematically possible. And then the other thing that I will point out, that I'm not really, to be completely honest with you guys, I'm not in a position to really intelligently talk about it. But one of the other reasons I want to get this estate planning attorney is there is the DST, right? The Delaware Statutory Trust. Now there's a Wyoming Statutory Trust, which there are ways to structure syndication using that entity, although there's some pros and cons against that. So that's going to be a future live that I want to bring on, probably Kevin, who's the estate planning. He's an expert in DSTs. So that's another way we do it. But structurally speaking, again, there's a video that I actually map it out, but I'm going to do a follow-up so we can talk about the IRS revenue procedure. I'm pretty sure it's 2002-20.
Awesome. So Michael Shine has a question. Michael, I think this was the topic of a whole hour-long discussion last week. So I want to warn everybody, we're not going to go an hour into this, but we could. Michael, do you want to unmute yourself and ask your question?
Sure. Thank you. So recently I've been asking people for money, just general discussions before we set up a syndication. And a lot of the responses, nice problem, they've been saying, yeah, I'd be happy to give money, but I also have this other friend of mine who has a lot more money than I have. Maybe they can invest. Is there a way for the middle person, the person I'm asking, to get compensated at all? Because I'm assuming they can't just be part of the GP, because you can't have 17 people as GPs saying that they do something else besides raise money. So
Yeah, the Cliff Notes version is no, you cannot pay a referral fee or any direct commission unless they're a licensed broker dealer. But yeah, our entire last episode was about, you know, how to legally bring in what we were affectionately calling money raisers into your legally into your sponsor team, and what really needs to happen for that to be true. And under your fact pattern, if they're just referring someone, they're not doing substantial duties, so that's not going to work. But we went through that, so I would highly encourage you to look at it's on. Actually, it's not on YouTube yet. It's in the community Facebook group, but I think that's going to get released today or tomorrow. So either check the community page, the Facebook page, or check the website. I'm sorry, the YouTube channel. And then the other way is the fund of funds. So the other way to do it is if they're really good at raising capital and they've got somebody, maybe they can create their own syndication and do that legally and then invest somewhere else. For that one, I'm going to refer you to episode 2 because we did a whole fund of funds. Actually, that we did talk about funds. It's actually the fund of funds portion is probably the second half. And just as a reminder, you know, the first, I think for that one's about 30 minutes, but usually the first 30 minutes is the keynotes, is what I'm calling. So you don't have to watch the whole 2 hours or whatever that was that's on there. But if you watch the first 30 minutes, you'll get, I think, all the information you need from that. So episode 2, which was the second one, and then the 6, which will get released, I think, tonight or tomorrow. Thank you, Mike.
Thank you. Appreciate
Thank you,
it.
Michael.
And Natalie has asked about clarifying with respect to going from a 506B to a 506C. Natalie, the answer is yes, but do you have a question about clarification on that? No, we might have lost Natalie.
Yeah, so if this is gonna be fun, I'm gonna start referring people to prior. So the first one, the inaugural live that we did was because I knew it's controversial, but
I'm here.
Oh,
I'm
Natalie,
here.
so why don't you ask your question then? Because I mean, the question originally was, can you go from a B to a C, which is what we talked about in episode 1, which the answer is yes. But I don't know if you had any clarifying questions, or you want me to spend 20 seconds on explaining it.
Yes, can you bring in investors that are non-accredited into the 506B, and then once you move over to your 506C, can you bring those B non-accredited investors over to your C once with the accredited ones and still use them?
Yes, the answer to that is yes, although the way you framed it is not
It's
the right way to
confusing.
frame it. It's confusing. So you're not bringing non-accredited investors from your B over to a C. You're actually doing 2 completely separate offerings in terms of exemptions. It's the same deal, it's the same property, it's the same LLC, it's the same everything else, but there are 2 completely different offerings. Your first offering is a 506B. So we comply fully with 506B, which does allow you to take up to 35 non-accredited as long as you don't advertise. But at some point we terminate that B, no longer accept people, no longer accept documents or money, no longer, out there, trying to get people under the 506B, and we pivot. And from that point forward, we're doing an exclusively a 506C, and under that 506C, we're complying fully. So we are advertising, we're generally soliciting, but we're limiting ourselves to accredited investors only, and we're taking reasonable steps to verify. So we're complying fully with those 2. We just have that proverbial Chinese wall in between. We're not combining them into one. And what the ruling is, the SEC is saying now is that if you do that, start with a B, stop completely, start with a C, and treat those completely separately, they will not integrate them. They will not combine those 2 offerings into one, which is what they would have done, a year ago. But as of March 20th of last year, so it's been just over a little bit over a year, we can do that. And in fact, we've done that now with I don't know what we're up to now, maybe 6 or 7 clients who are starting to do that as word of this is getting out. So yes, you can do it, but you're not commingling. It's literally 2 parallel tracks. It just happens to be the same deal, the same LLC. We do create separate shares, but it's essentially very substantially the same documents and everything.
Okay, gotcha. Thank you very much.
Of course. Thanks, Natalie.
Awesome. So Yukiko has an interesting question with kind of a twist. Yukiko, are you still on? Maybe not. Okay. So her question, she invested as a passive in a 506B deal. And so her question is, can she post in social media that she invested in the deal and post progress pics and the like?
Sorry,
Oh,
I
you're
can't
here.
unmute.
Oh.
Sorry.
That's
So
okay.
I invest in like a ground up project, and then I kind of want to like a post like a progress, it's like a going on like a, constructions, and then so that I can show I'm in a real estate, and then, investing this type of commercial project to kind of start getting tractions in a social media. Is that possible?
Yeah.
But this is
Yeah, great question. Yeah, I don't have too many, the issue there is control, which was kind of going back to Melanie's question on the website. That when somebody's posting something on your website, or certainly on your page, meaning the syndicator's page, Facebook page, LinkedIn, Twitter, then they have control of that. But if you're out there, we have no control over what you're doing. So if you added for your own purposes, which you articulated well, you want to post about, hey, I'm super excited, I'm investing in so-and-so's deal, or I'm a passive investor in this development deal. It's been awesome. And, I really highly recommend other people to join me in this journey of, passive investing. I don't have a problem with that, as long as there is no collusion, for lack of a better word, between you and the sponsor, right? I mean, and this is not what's happening, but the sponsor can say, hey, Yukiko, do you mind, it'd be really nice if you posted something nice about, that kind of stuff. So if there's any of that communication, that would be a no-no. And for the syndicators out there, you just got to be super careful, because, just remember, I'll give my usual reminder that when things go south and, the day comes, hopefully it will never happen to you. But if you come through the day that you've lost all of your, the deal goes south, either no fault of your own because the market collapsed or just something happened, and you lose all your investors' money, your passive investors are not going to be your friends. They're not going to be saying, oh yeah, no, this was all, they're going to be saying all kinds of things because they want to get their money back and everything like that. So definitely don't get involved with that. But if you, Yukiko, want to do that because you want to, teach other people about the benefits of passive investing and you want to show progress, as long as there's no control from the sponsor, I don't have a problem with it.
Thank you so much.
Yeah, of course. Thank you.
Thank you. Baron Campbell has a question where you're going to be able to refer back to an earlier episode. Baron, are you still on?
Yeah, I'm still on.
Okay, so you want to ask your question?
So yeah, I'm starting to see some other people doing this, and I'm just wondering if it is a 506B, can you on social media just straight up advertise your deal? Say I've got this deal, I'm looking for this, and kind of give some general terms. I'm actually seeing quite a few people do that, whether it's actually on LinkedIn or Facebook. And if that's something you can do, because these are people that are in your network, whether professionally or personally.
Yeah, that's a resounding no. So, and yes, you're right. In fact, I just saw another one the other day. It was, every so often I'll see these that are, I just take a screenshot of them, and I'm sure I'll use them in a webinar or something. But no, you can absolutely, it's a 506B. That means you cannot generally solicit or advertise. And so the general rule is, which we're kind of going to talk a little bit about it next week, but the general rule is that you must have a substantial, a pre-existing substantive relationship with that person. And so posting it on social media is, especially if you're specifically talking about your deal, that's going to be a no-no. In fact, it goes further than that. You could actually post something that's not talking specifically about your deal, but that it can be considered what we call conditioning the market, which means you're posting it, you're getting people excited about your deal, even without referencing it. Great point, as I always like to say, is the due diligence videos that I see out there where people are on there, they're talking about the walkthroughs or whatever, and they don't necessarily mention the actual deal itself, but it's very clear that they're there, they're under contract, they've got investors, and they're really talking about it. And I think that crosses the line to conditioning the market. I saw an amazing post from who was it? I was going to show you guys, but he did it was one of our clients, Brent Ritchie. Brent Ritchie was doing an amazing, I think it was a 5-part video. I only saw the first part, so I don't know about the other 4, but the first part was a 5-part video of him and his partner going through and doing the due diligence on a building. And it was 100% pure value add, meaning what is it that I'm looking at when I walk these units? And it was an amazing video, and that's a value add piece. So adding value is always acceptable when you're not talking, but you're not referencing your deal. It's almost like people have no clue that you're raising capital. That's really the way you should be posting it. But the minute you start, mentioning investors and all that stuff. But Baron, to go back to the answer was simply, that's a blatant violation. So I wanted to kind of give you a little bit more content there. But no, you can absolutely not post about your deal. You cannot say, hey, I'm looking for investors. I've got a 100-unit apartment building, and yes, a lot of people are doing it. And although sometimes it's hard to tell, right? Sometimes I see a post that is clearly advertising, but that might be a 506c, right? We don't know. So I always recommend you guys putting, when you do a post under 506c, to have a little asterisk there at the bottom, just making it clear that this is for, a lot of people put for accredited investors only, which is great. I would even say this is a 506c deal, for accredited investors only. That way there's no confusion. There's no chance that one of your competitors can forward that and snitch on you to the regulator. There's no chance that a regulator is just perusing and sees it. Even though you're in the right, because it's a 506c, it still takes time, money, nonsense, and all that stuff away from you. So just to be safe, I think it's good practice, but to put that little asterisk. You've seen me share the Grant Cardone post these days. He has an asterisk with a whole freaking disclaimer in there, which I love from a security standpoint. I love, but just even an asterisk that says this is a 506c eligible for accredited investors only. But if it's a 506b, those are blatant violations. And and I know it gets frustrating sometimes, although I see less and less of them these days. But it's almost like they have an unfair advantage. But the reality is, when things start going south and when people start losing monies, then that's going to be an issue for them, because that's going to be a violation of their 506b exemption, which then throws them back into having the allegation, not the allegation, they're going to have an unregistered offering. Because as remember, the rule is you have to either register your syndication with the SEC, or you have to have an exemption, right? Or it's illegal. So if you don't have that 506b exemption, then you have an unregistered offering, and you're scrambling to find what exemption do I have that I can rely on. And so absolutely stay away from my, as you guys know, my recommendation is, if you have an active deal, stay off of social media, period, other than posting about your kids and your cats. So I wouldn't even try to, even the due diligence videos, I prefer that you record them and then use them as value add later on. And then obviously progress pictures are also another favorite of mine. If you want to show the before and after pool pictures, or the before and after cabinets or whatever from the kitchen renovations, that's all good as well. But absolutely not, Baron, in terms of posting about your deal on social media. Unless the only exception I'm going to say to that, and give you one little exception, which we talked about again, is if you have a closed group, like a Facebook group, or just something that requires access, right? So if in order for you to come into my Facebook group, you have to spend time with me and you have to go through the process, which we're going to talk about next week, of getting to know that person and establishing that substantive relationship, so that everybody in that group you have a pre-existing substantive relationship with, then that would be okay, I guess, theoretically. But if it's just on your regular Facebook page or whatever, that's going to be considered a general solicitation.
Okay. Thank you.
Yeah, of course, Baron. Thank you. Great question.
Thanks, Baron.
Emma, Emma mentioned, I just saw that. Emma said, next time you're going to play the guitar for us. I was doing a podcast with, Julie, I forget. Oh, I apologize. I forget. But she said the same things. Like, one of these days, you just got to start busting out the guitar and having some kind of a securities jingle, kind of like who does the Hanukkah songs? Adam Sandler. But no, I'm a beginner, so I wouldn't embarrass myself unless I do a Wine Wednesday one of these days. But no,
I was just wondering if it's a virtual background, if the guitar is actually
no,
real.
The guitar's actually there. It's out there. Yeah. No,
it's real. We've got a couple of questions that are kind of specific. We'll try to get down to those. I want to get the more general questions answered that people have asked. And Cornelius, I believe your question was just answered about the 506B and the private groups. But if there's more that you want to ask about that, please go ahead.
No, I was just wondering about the steps of doing so, because I know he just said that we can do a Facebook group, but if I have a separate group that's away from Facebook, maybe on another platform, how can I make sure that we're all compliant, that say that what we do know each other are? Cause I hear some kind of like sometimes like these coaching groups, they have thousands of members in there, and they always say that we're part of the same group. That's how we know each other. Which I feel like is that efficient enough to actually do a 506 to do a B deal? Yeah,
it's tough. I mean, the person organizing the group could potentially argue that they have a pre-existing substantive relationship with everyone. But it's going to be an individual one-on-one. I mean, you literally would have to go through those 1,000 people. If one random person in that group invested and then the deal goes south, how did you meet this person? Oh, we were at a Zoom, like in this group right here. If I suddenly, it's probably, I don't even say it's okay for me, but let's just assume I had a pre-existing relationship with all of you guys. I could pitch my deal if I had one, but you guys couldn't pitch each other because you guys don't have that that pre-existing substantive relationship. Now, if it's part of there's the other, there's another thing that we'll talk about next week, which is, again, 99% of the time, having a pre-existing substantive relationship is the way to go. There is a way to do it through the sort of a referral network, where one of the people in the group, and you have a pre-existing substantive relationship with that person in the group, and then there's an assumption that everybody else is that. Maybe that's what they're talking about, but we're going to talk about that next week when we talk about, taking random, we use the word random, I'm not sure if I use that on the official title, but taking people you really don't know, strangers, capturing them, and then going through the process of establishing a substantive relationship. We'll go through those 7 or 8 steps next week, and we'll get more details there.
Great, thank you.
Thanks, Cornelius.
Just a reminder to mute if you're not talking, please. Scott Dilly had a question, I think harkening back to the 1031 conversation. Scott, you're getting maybe gonna outsmart everybody, but you want to ask your question here. That I can give you the high level. I can give you the high level answer.
Okay. We recently did a deal where we had a tick, and we did a option to purchase that tick. And with that option, the way it was explained to us is that the option would be used to remove the tick from title and then be absorbed back into the limited partners or other investors with that option. Have you heard of that, Mauricio?
I not only have heard that,
yeah.
not only have we heard that, I believe we actually did it.
We've done it before.
So maybe Bethany, you can talk about it, but I'll give you the caveat before Bethany can kind of maybe explain it to you. But the bottom line on that one was, it was an attorney, I think a corporate attorney, that suggested it, and we took the position. Look, if the corporate attorney wants to stick their neck out and say this is legit, and the CPA also says this is all good, we're happy to do it that way. But Bethany, if you want to, I don't know if you want to explain it or stuff, but I have heard of that, but
with that big caveat that our job, keep in mind, our job as the securities attorneys are to make all the proper disclosure, make sure you're compliant with SEC, not 1031, not the IRS, whatever. So we are going to rely on your other advisors as it relates to those other things. So that's the big caveat, though. The answer is we have a couple clients that have used this. They actually paired the option with a master lease agreement to kind of play with the payouts a little bit, so that it wasn't just a direct percentage of whatever their pro rata share of the ownership of the property is. So the very high level answer is yes, we've seen it done. Yes, we've done it. I would want to get a written blessing from your advisors. I would also have them draft those documents and then attach drafts as exhibits to say that hey, investors, you get a chance to look at, you don't have to see who they are necessarily, but you get a chance to look at what these agreements are to make sure that your advisors are comfortable if there's any question.
Yeah. And there's also a disclaimer in there and a disclosure that, hey, this hasn't been approved or reviewed by the IRS. So there's always a chance that this may blow your 1031. So
Right.
we make sure you're covered from that perspective. But yeah, that I've seen those.
And that's really for the 1031 investors. And we're also making disclosures to your other investors. Whereas, if you're getting sued and somebody who has a direct ownership interest in the property can then collect on that somehow, that's going to take away from what your other investors would otherwise get. So we do have to.
Those are the issues with tick. So that Bethany mentioned perfect. There's 2 issues. One is if the 1031 gets blown and the tick person coming in has a huge tax liability, are they going to go blame it on someone? Which is why I want to see, a CPA letter from their CPA basically signing off on it. And then there's exposure potentially for your other investors, because like Bethany said, if that tick blows up and they end up suing the manager and suing the syndication LLC, everybody's going to get, brought into that. And the other main risk is that with a tick, generally, I understand that you've got all these arrangements in here, but the lenders and title, the title company, the title insurance and the lenders are most likely going to want everybody's signature on that document before you're able to either do a refinance or not a refinance, but a sale for sure. And so they basically end up with veto power, right? So if that 1031 investor, they may only own 5 or 10% of the deal, but if they, for whatever reason, don't like the idea of selling it when the manager decides to sell it, they want to hang on for a while, they can probably hold that sale up because they're going to, the title company and the new buyer's lender is going to require everybody's signature because they want to make sure it's safe, that they have the authority to go ahead and sell the property. So there's a lot of issues going on there, but yeah, check with your CPA.
Well, and my other follow-up question is when it's absorbed back into the general LP, the LP side, there's, like you mentioned, Mauricio, there's expenses with just changing title, with taking the tick off of title, and with the lender. Is it typical for the tick to pay those expenses for that transaction?
You also have that, but I'm sorry, and then you also have, you're right, then you have theoretically, potentially you could have the due on sale clause triggering if the lender hasn't been made aware of. So
the lender is okay with it.
Oh, the case, okay. Yeah. So so the syndication. Well, actually, I don't want to. I was going to say my expectation would be that the syndication LC would pay for that. But again, we've only done it, I think, once or twice, and I don't think any of those have gotten. Bethany, have any of those actually triggered? Because it's usually a year or two that they want to keep it in there before they exercise options, right?
They haven't triggered. We've got some that would be coming due soon because we have one client that does it repeatedly. So they haven't really been triggered yet. However, their lender is always aware. It's gonna, whoever's drafting the TIC agreement and usually there's also an asset management agreement that goes along with it. They can just carve it out in there and say who's responsible for it. Nobody should be surprised when it's come time to pay a bill, who's supposed to pay it, right?
That's the part that is not in the TIC agreement or the option agreement of who's paying for what. That's why I asked you guys who typically pays for it.
Then I would say that the person who the 1031 investor, my position would be you shouldn't make your investors do it because you didn't disclose that they might have to pay for that.
And that's why it gets messy.
That would be the SEC lawyer's position, right?
And this is why it gets messy too, because all of these things that are kind of borderline grayish, when there's an issue, the last thing you want is an issue popping up, right? Because then it's like everybody starts complaining, and then suddenly this becomes sort of, it gets brought to light. So that's one of the other reasons I'm always hesitant to do these things. But yeah, we've done it on the front end, but we haven't done it on the back end. So, but that's a great point, Bethany. If it's not, it's hard for you to have the investors absorb that cost if that wasn't disclosed on the front end of the PPM, that, hey, this is what we're doing, which you would have disclosed, that there's a master lease, there's an option arrangement, and then we're going to execute the option at this point, and we disclose the risk of that. And then, oh, by the way, if the investors are going to end up paying it through the LLC, that would be a disclosure. I think you're running the risk of somebody complaining, saying, wait a minute, I don't know how big, I mean, this may be trivial amounts compared to the main thing, but that's definitely a risk. All right, let's do a couple more, because I've got to head down and do our family dinner.
Okay, so Alex Neely has a question about when he's updating his investors, what he can include in those newsletters, or actually not just investors, but database. Alex, are you still on?
Yeah, still here.
There you go.
Yeah, so like when we send our updates to the people in the deal, we can obviously disclose everything you kind of want to, but to our entire database, we're thinking about saying when we underwrote like these 4 deals that we're general partners on, we estimated expenses to be this, income, NOI. But actually, we have much higher income, lower expenses, a higher NOI. This is an example of conservative underwriting. Is that okay to do to the entire database?
So your database should be segmented, right?
Yeah.
There should be for lack of a better, you can do whatever you want, but like a 506B subset that you would. So there, I would have a 506, however you want to call it, but a 506C list.
Okay.
And I would have a 506B list where everybody on there you feel comfortable that you either have a pre-existing substantive relationship or you've known these people forever and they're your high school friends or workers, or it's clearly that you've known them for a long time. Okay. So that's my 506B list. Then 506C would be everybody else, right? So if you're doing that type of a blast, I would only do it that has the risk of being considered conditioning the market. Right. And so I would limit that blast to the people on your 506B list because you have a pre-existing substantive relationship with them, or you have that relationship with them. So I'm not worried about conditioning the market. I would be a little wary of sending that to somebody you just met at a conference last week, or that you met them here, however you met them, and you haven't gone through that process.
Right.
But I think if I almost call it the clean list, if you have the clean list, I think I think that is completely fine. It's the non-clean list that I would have. It gets a little bit murky and I would stay away from that.
Okay. Hey, thanks a lot.
Yeah, of course. Thank you. Appreciate you joining. Appreciate all of you guys. We actually had about 110 people as our record show up today. So, and obviously Russ is a big draw, but let's do maybe one more, Bethany, and then I mean, these could go on for hours and hours. And just look, we do these every week. So hopefully if there's a question that's unanswered, please come back. Like I said, next week, we're going to talk about how do we take, complete strangers and get them eligible for your deal. And there's, you've heard me talk about the 8-step process. So we'll go through that 8-step process, get into details, and then we'll open it up to AMA again.
We only have 2 more questions total.
All right, let's do those
actually.
last 2 then. Let's do the last 2.
And then can you just drop the link to the Facebook group? Yes, Terrence, we'll get you guys the link to the Facebook group as well. So
It'll actually be in the replay, because now it'll be in the replay email. I'm still trying to figure it all out. So I'm actually trying different things, but when I send a replay email, which will be probably tomorrow, I'll have it on there. But while you ask a question, maybe I'll just go find it.
Okay, Ezekiel, are you still on? I thought I said, there you are. Can you unmute and ask your question? Ezekiel, you're muted. All right, I'll ask it. Ezekiel is asking if can non-accredited investors in a conversion increase their initial investment amount? So conversion into, do you mean when you convert from a B to a C? Is that what you're asking?
Yeah, actually, Bethany, that was my question.
Yeah.
And Ezekiel may have a similar one.
Yeah, you know what? Ezekiel is who you're listed as here. Sorry.
So we did a 506C conversion, and we've had some, we haven't closed the 506C out yet. We did close the B out.
When you say conversion, meaning from a B to a C?
Yes.
Okay.
Yeah, we converted from a B to a C, and now I have. Go ahead.
When you, I just want to make sure I get the content. When you say convert, I haven't really heard that term. So when you say conversion, you mean you started your deal as a 506B, you then said, "Oh crap, I don't want to do a 506B, so we're going to do a new exemption, which is 506C." Or are you talking about the transitioning, starting with a B, and kind of what we talked about earlier, starting with a B, terminating B, and then doing a C?
They went to a B2C, and sorry, I needed to get my glasses re-upped because the pictures are so small. So I apologize. It says Ezekiel, but they did a B to a C. So he's asking about after they do the conversion, right? That can someone who came in as a non-accredited in the B side increase after the fact? Can they say, hey, I want to double down?
So with the 506B conversion, let's call it conversion. I haven't used that one before. That's good. I use transitioning, but that's fine. Remember, you have terminated that 506B offering, right? So you started on B, and then as of today, let's call it April 1st, you are terminating that offering. So you're not letting anybody in that offering, right? Then you're switching to a 506C. I would not, you're trying to make the argument, well, I think what you're making the argument is I had a non-accredited investor in the B, and now they want to increase their amount, but then you would almost be opening up that round again, which, I mean, we have zero guidance on it, but that's not something I would play around with. If the investor is an accredited investor, then I would just have them come in under the C, and you'd have to verify them. I would not reopen, because that's the main thing. They're really, the way I interpreted the reading of the rule is that you've got to have that sort of that very clean separation. And I would not, I'm not saying it's not going to happen, but I think you're just taking on, and I would be uncomfortable with that risk, because you're going to run the risk that you basically did a B, then you went to a C, and what you cannot do is go from a C to a B. So that's the risk that you're running. So I would not recommend doing that. And I think that's where it's really critical on the B to C is when you're doing your B, you got to give them a short windows. Like, guys, I don't have all day because I got to close. So this is going to be open for a week or 2 weeks. And if you're in, you got to make the commitment right away and make sure you're fully in, because when I terminate this thing, it's done. And because it takes time, you don't have all the time in the world to close. And so you got to get this thing going.
Awesome. And that's a good transition to our very last question. Melanie, this is a great question that I'm sure a lot of people have about if you're doing both 506B and D, or sorry, 506B and C at the same time.
Yeah, so I have a fund of funds and it's a C fund. So I'm assuming I can advertise that. But if I ever wanted to do a B, just an SPV or something, would that be a no-no? Because now I've completely conditioned the market and put all my C deals out there.
Is it a completely different deal, or is it still similar? Is it somewhat similar?
Just another, no. So like in my fund, I do multifamily, I do assisted living, I do all sorts of stuff, but I might want to do just a one-off deal here and there because I have friends and family that want to do a deal and aren't accredited.
Yep. So the good news is, this is what I would recommend. It may not be the only way to do it, but this is definitely the safest way to do it. is this B2C transition came about because they completely revamped the integration rules. They used to have a safe harbor where if you started a deal and you waited 6 months before you did the next deal, then that they would not integrate those. So even if it was literally the same deal, it would 6 months was enough. They shrank that to 30 days. So if you start your syndication and you stop the syndication, and by the way, yeah, if you stop syndication, then you wait 30 days, they're not going to integrate those. So that's what I would do. I would just wait 30 days.
Perfect. Thank you. By the way, I really appreciate this. So useful and helpful.
Oh, I
Thank you
appreciate
for-
that. It's been super fun for Bethany and I. You know,
Yes.
so many of you guys stick around for, I mean, there's still 55, more than half of you are still here, which I'm always shocked and honored. So I appreciate you guys doing this. It's kind of been fun creating this little community. Next week, like I said, we'll do the not the B2C, we'll do the 8 steps to take a complete stranger and get them as a pre-existing substantive relationship. And then we'll continue to, I hope you guys found the guests valuable. And again, my Bethany and I's goal here and vision was never to do this legal. It's already gone too long on legal, in my opinion. We've really done 7 episodes and 5 of them have been legal. The goal was always to just come up with topics that are valuable to syndicators, whether that's underwriting, due diligence. I mean, I want to get all those guests in to talk about a particular topic. Today happened to be raising capital from Russ, and I do want to get other lawyers involved. So hopefully it's not just Bethany and I talking legal, but I really appreciate you guys doing this and sticking around with us. It's super fun for us, and we'll hopefully see you guys next week.
Yeah, and mark your calendars, by the way, for April 28th, which is going to be a Thursday this time at 4:30 Pacific. We're going to have an amazing panel of some badass women in syndication. So we'll let you know about that coming up, but mark it down now, April 28th.
All right, everyone, that'll be fun. We'll see you next week, hopefully. Bye,
Thanks,
everyone. Thank you.
Thank you.